Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing Podcast. CMQ investors, welcome to the show. It's great to have you here. Make sure you subscribe if you're listening on Apple Podcasts and hit the follow button if you're listening on Spotify. That way you'll be first to get the new episodes and you'll be able to use the information before everyone else. As you know, especially if you've listened to episode 6, a stock is a piece of a business. And as CMQ investors, the only kind of businesses that we want to own pieces of are great businesses. In this episode, you will learn about some of the indicators that investors like Charlie Munger and Warren Buffett look to when determining whether or not a business is great. This episode was actually inspired by a question I received from one of you, meaning one of us, a fellow CMQ investor. It comes from Henry Boulos. Let me read you his question, and I quote, "Dear Franco, as an amateur investor, I've relied on low-cost index funds since my mid-20s, and now, at 45, they've served me very well. Being in the position that I am now, I would like the opportunity to be a bit aggressive with a small percentage of my portfolio to try and hit on some individual stocks. I've not done it to this point, not because I'm risk averse, but due to the fact that I don't want to guess. I know it's always a gamble, but I'd like to make educated gambles. So my thought for an episode is, how do Charlie Munger and Warren Buffett identify great businesses? And for the average person, what are the 4 to 5 indicators that the amateur can look at and think, this could be a great business? Thank you, Henry Boulos." Henry, thank you for that question. I don't want to make you wait any longer, so let's dive right in. Indicator number 1 of a great business has to do with something called ROCE, R-O-C-E. It stands for Return on Capital Employed. Warren Buffett says the best businesses by definition are going to be businesses that earn very high returns on capital employed over time. It'd be great if that business also doesn't require a lot of additional capital. Imagine there's a business that you own a piece of or you own all of, and every year it just spits out money your way. Now, what would make that business even better is if you didn't have to put any additional capital in to that business and you still got that big bag of money every year. That is the best business. So a high return on capital employed, and if possible, a business that's not capital intensive. And keep this in mind, you want to look at return on capital employed over a long period of time. So go back, and I'm making up the range, but let's say 10 years, and look at how a company's ROCE has changed year to year to year to year. You get the idea. And last but not least, and this will be a good transition into criteria number 2, it's critical that you look at these metrics like return on capital employed and look at them in context of the competitive universe. So let me just speak without talking in jargon. Look at how the competitors are doing relative to how you're doing. If you're looking at a business and you've done the due diligence and you can tell me what the return on capital employed is and how it's changed, in the last several years, that's great. But that's not enough. You have to understand the metric in comparison or in context of what the business's competitors are doing and how they're performing. Can't emphasize that enough. Compare, 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 compare. Now, speaking of competition, let's get into indicator number 2. Indicator number 2 is a competitive barrier to entry. There's a great opportunity right here for a Charlie Munger quote. The quote goes like this: "The game of investing is one of making better predictions about the future than other people." So what does that mean? Well, this is my interpretation. The value of a stock or any financial asset is the present value of future cash flows. Let me just say it one more time. The value of a stock or any financial asset is the present value of future cash flows. So when Charlie says that the game of investing is about predicting the future, I think he's actually saying predicting the future cash flows of a given business. Now, no one is claiming that the future can be predicted with certainty. That's literally impossible. But businesses that have durable competitive advantages, competitive barriers to entry, well, those businesses have more predictable future cash flows than businesses that don't have competitive barriers to entry. I'll show you why. Let's say you and I start a car wash and we have some sort of innovative process that we've invented, and that process allows us to wash more cars per hour than any other car wash in the entire world by a long shot. Because we're running such a great car wash business using our super innovative process, we're able to earn above average returns on capital employed. Well, since we're in a free market economy, this is what tends to happen. Our competition starts noticing, and they say, hey, what's going on over there with Franco and Henry's car wash? What are they doing? Anytime a company figures out how to do something and it's very profitable and they're making money hand over fist, it usually doesn't take long before there's competitive forces that enter the equation and do nothing but drive down profits. Only a business that has a competitive barrier to entry and a durable competitive barrier to entry, only those businesses have a chance of maintaining and continuing to build on the success that they've already had. So those high returns on capital employed, if we want to keep that moving in the right direction, we need to keep the competition away. And maybe it doesn't require us to, physically say, no, like get away. But when they're doing their due diligence, they come to the conclusion that, the effort that would be required to try to play our game, it's just not worth it. They're not going to be successful because the writing is on the wall. And that writing on the writing on the metaphorical wall is the competitive barrier to entry. Before we move to the third indicator, I want to conclude with a couple of Charlie Munger quotes. The first one goes like this: we have found that in a long life, that one competitor is frequently enough to ruin a business. Think about that. The presence of one new competitor, a competitor that maybe wasn't there when you first started your business. Maybe it wasn't there for several years after you started your business. But one competitor's presence can ruin your business. And that reminds me of something else Charlie Munger said, which is that when you're looking, you see a business that's having fabulous results, the question you have to ask is, how long can this continue? Charlie goes on to say that there's only one way I know how to answer that, and that's to think about why the results are occurring now, and then to figure out the forces that could cause those results to stop occurring. Well, competitive forces are one of those forces that will undoubtedly cause those results to stop occurring. So invest in businesses that have competitive barriers to entry. The third indicator of a great business is loyal customers. Look for a customer base that is large, look for a customer base that's growing, and look for customers that are staying after they become customers. That is a recipe for success. And it actually relates back to our previous criteria when we were talking about predictable future cash flows. Let me give you a real example. An article I read on Medium estimated that Blue Apron's retention rate was about 30%. Now let's compare that to Costco. Now it's not apples to apples, but Costco, which has a membership and requires yearly renewals, Costco's retention rate in North America, Costco's renewal rate in North America is 90.1%. So 30% versus 90%. Now I'm not even getting into the volume of customers that either of these businesses have. The bigger point I just want to focus on is how much easier it is to predict what's going to happen in the future for a business where you're keeping most of your customers year after year. You have a product or a service that is producing loyal customers, not just customers, loyal customers. Now, another great thing about loyal customers is loyal customers can become advocates. Advocates tell their friends about it. They show up at their neighbor's door in the middle of the night and they say, hey, I know it's late, but you got to hear about Costco.
It's 3 o'clock in the morning.
Is everything okay?
Yeah, it was just a neighbor.
Oh, you love it when she comes by, don't you, you frickin' pig?
Oh, my face!
Indicator number 4 is big growth opportunities. A great business gives us back more cash year after year after year. And one way to help ensure that's even a possibility is to buy pieces of businesses that have big growth opportunities. When Warren Buffett and Charlie Munger bought that big stake in Coca-Cola, we talked about that in episode 3. Some years after they took this big position, Warren Buffett noted that Coke is expanding in China. And he said that it's nice to have markets like that are relatively untapped. I'm sure he said, no pun intended. Tapped, get it? And then he got booed off stage. Now, if you're a free subscriber to our newsletter, cmqinvesting.substack.com is where you can find it, by the way. In one of the very first things that I published, I talked about why I bought shares in Chewy. When I bought shares in Chewy, only 22% of pet product sales were happening online. Now, for reasons that I won't get into right now, I saw that as a major growth opportunity. Now, remember this though, opportunity means nothing if the company cannot seize the opportunity. Now, I'm noticing this right now, by the way, so forgive me for patting myself on the back, but all of these criterias, all these indicators, however we're describing them, these characteristics, they're all related. So if a business has a competitive barrier to entry and there's a big market opportunity, a big opportunity for growth, well, that's a great recipe. But if the business is in a highly competitive space, well, I'm not as confident or I'm not as certain in any sort of prediction that I'm going to make about its future. Indicator number 5 is untapped pricing power. Now, untapped pricing power is something that's great to have, not just in an inflationary environment, but in any environment. For example, if you want to improve your gross margins, one of the ways you can go about doing that is by increasing your prices. But not every business can increase their prices without losing customers. There are some businesses that if they raise their prices, they say goodbye to a nice chunk of their customers. There are other businesses that when they raise their prices, their customers don't even notice. Not because it's some secret or it's hidden. It's because they get so much value from whatever it is that company's offering that they're willing to pay more and not even have an issue with it. I think of iPhones as an example of that. I'm trying to think what else. How about Chipotle? Actually, that's perfect because Chipotle recently announced that they are raising their prices. And I have been back to Chipotle since that price increase happened. And I'd like to report to everyone that I'm still buying burritos. And also, I am morbidly obese. Okay, I don't want to make this episode morbidly obese. There are more indicators than just these 5. These were my first 5, my top 5. Of course, it could always change. I'm always learning new things. I'm also always thinking about this. There will be a follow-up, so look out for that in the coming episodes. Much more great content is on the way. Please subscribe if you're on Apple Podcasts. Please follow if you're listening on Spotify. This has been Compound Money Quietly, the CMQ Investing Podcast. My name is Chris Franco. Thank you for listening. We'll talk soon.